Speaking of GDP, the U.S. economy slowed in the second quarter, growing at a 2.4% annual rate. That's a worse performance than expected. The scarcity of jobs still cutting into consumer spending. Let's talk about that with David Tice. He's chief portfolio strategist for bear markets at Federated Investors. His prudent bear fund, by the way, ranked in the top 2% among its peers over the past 5 years. David, welcome to the show. Thanks for joining us.
Glad to be here, Matt.
Let me ask you first about the GDP numbers, because while they were worse than expected, and while we see concerns about consumer spending, obviously, and jobs, we haven't slipped back down into a double-dip recession. Is it possible that we sort of muddle our way through this recovery until an expansion on the other side, say, in 3 to 5 years?
Anything's possible, Matt, but I really think a double dip's in the cards. When you look at that 2.4% number, it was helped by 1.4 percentage points by the buildup in inventory. So without that, we only grew at 1%. It was also helped by a 4.4% increase in government spending as the government spent money like a drunken sailor. Also, you look at residential construction was up 28% due to tax credits. So without those two factors, we would have been flat. And this was with massive stimulus.
The government, though, is spending less. We see less of these fiscal stimulus programs for the consumer and less spending in the business arena as well. And yet, corporate profits have beaten by, I think, 77% of companies that have reported have beaten estimates. And we've had a real expansion in corporate profits in the second quarter. Why do you think that companies are doing so much better than consumers?
Well, corporations are doing well because they've really cut back labor. Labor as a percentage of sales are, I believe, at record levels, record low levels. And essentially, corporate profits have been helped a lot by financial companies. Financial companies are generating a lot of the aggregate growth in profits, and the suspension of mark-to-market accounting has certainly helped there.
So you don't expect companies eventually to start hiring. They're holding a lot of cash, obviously. They're starting to build plants. They're starting to make equipment purchases, but you don't expect them to start hiring and to work unemployment back down into another expansion.
Well, June was a lot worse than April and May, and therefore we've had a number of indicators get dramatically worse just in the last few weeks. You look at consumer confidence, you look at retail sales, you look at several other indicators that come out. Housing has remained weak. I don't really think
housing seems to be bouncing along a bottom, David. Doesn't it look like, at least in housing, you've got to see the next move up rather than the next move down?
We saw a slightly better number with the last number, but it's very, very, very low levels. It's still at very depressed levels. And now I don't think that's going to help us at all.
You don't think that fiscal stimulus is the right way to go? You are one of the Austrian thinkers on this issue. But what's the alternative? If you can't try and if the government doesn't try and boost the economy with fiscal stimulus, and we see a drop in growth, what do you expect?
Unfortunately, the alternative is not pretty. However, it's just like raising a child. You unfortunately have got to take the pain going through discipline. And essentially, we can't be good time Charlie as central bankers and policymakers. Warren Harding ended up cutting spending and cutting taxes back in the 1920-21 depression. That depression started worse than the 1930s depression, and we got out of it very quickly because we let the economy take the pain.
We have seen, though, a huge drop in stocks since the high in 2007, a huge drop in home prices since they peaked as well. I mean, have we deleveraged a significant amount, or is there a lot more to go?
We think there's a lot more deleveraging at the private sector. What's happened ever since 82, we essentially leveraged up the private sector every time, throughout the 25 years. Now we're going through private sector deleveraging that's being offset by public sector leveraging up. That's why we have sovereign debt problems. And unfortunately, you can't end that with this way because overall leverage is still increasing.
All right. Hey, David, thanks so much for joining us. David Tice, they're chief portfolio strategist for bear markets at Federated Investors.